Chapter. We're talking real money.
Cheesecake. Investment cheesecake. We've got lots of investment cheesecake coming your way today. What am I talking about? Investment cheesecake? Well, we can't say the P word because it makes some parents unhappy. But you know those dirty magazines? You know, the ones that sit outside in the dirt? I'm just helping you parents out. There's such a thing as investment P word, or cheesecake as we call it. It exists in the broadcast media, and it exists in the print media, or these days the online media. And Business Insider recently published a piece with this headline: "Tell me this is not cheesecake. Stock market crash, stock market crash." That's how it starts. 60% downside for S&P 500, expert warns. Expert. Yeah. See, now what are you going to think when you hear that?
By the way, there's an expert who was an investment banker at J.P. Morgan and Merrill Lynch. That should tell you everything you need to know, right? I mean, he's
a Wall Street guy.
Knows the deal and gets straight skinny about what's about to happen.
Yeah. So he's predicting that, we've had this nice run up in stocks in 2024, which has been pretty decent.
Pretty decent. In the last 9 months, the S&P 500's up 25%.
25%, yeah.
Yeah, pretty good.
So should you worry about this prediction? Let's talk about that for a minute. Will the stock market go down 60% in the future? That's the first question you have to ask yourself. Will it? How often
it never has gone
it?
down 60%. It's gone down 50 plus. It did as recently as 2008, 2009.
Yeah. So for it to do that would be an event of beyond historic proportions. First, that's the first thing we need to be concerned about. Second, why should we pay any attention to him? Because he has some fancy charts? Well, remember, charts only look backward. They never, ever, 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 ever look forward. And in fact, a lot of his charts, the bumpy lines going forward are much bigger than the bumpy lines in the past, which should tell you something. But what I decided to do was just look back a little ways. I don't want to go too far back.
You're not going to even mention his name on the show?
Oh, yeah. Well, his newsletter's called Bull and Bear Markets.
No, Bull and Bear
Profits.
Yes.
Yeah. And,
wow, that should tell you
his name is?
John Wolfenbarger.
John Wolfenbarger of Bull and Bear Profits. So why should you believe him? Has he been uncannily accurate in the past? So uncannily accurate that you would have been wise to listen to him in the past? Well, I just did a little search online and found a story from early 2021 from Mr. Wolfenberg, quoting Mr. Wolfenberger's prediction.
Barger.
He said that in the next couple of years, he expected the stock market would decline 40%. Not 60, but that was a pretty big decline. Between 2001 and 2024, where we are now, in the middle of 24, how has the stock market done?
I think 22 was a bad year, but nothing like
but
40%. Overall,
I went back and looked through, thanks to our good friends at IFA, Index Funds Advisors, who they have great calculators online. So I looked at their 100% total global market average annual return
since
from the beginning of 2021 through
I'll say
May,
7%. I'll say 7%.
No, through April of 2024.
I'll say 7%.
Annualized return over that period, 8% per year.
Pretty close. Pretty close.
Yeah. 8% per year.
That is not a decline of 40%. I will agree there.
No, that is the exact opposite of a decline of any percent.
That's a good point.
So why do we listen? What is it about us that makes us want to read that story? What made me want to read? Oh, well, what made me want to read it is totally different than what made you want to read it. Why do you want to read it?
Well, is it rubbernecking? Is it looking out at the accidents you drive by?
I think it's because we like being scared.
Yeah, I think you're right.
It's an
It gives you something to
emotional
worry.
thrill.
Mhm. Yep.
If the article said stock market's going to go up 60%, you wouldn't have read it. You wouldn't have read it. Because that's just not as thrilling. It's not. Think about a roller coaster. Is the fun part the ride up or the part on the other side of the hill?
Actually, for me, neither, because I'd stand and watch and you do it.
Yeah. No, that part's boring.
Yeah.
It's the thrill ride on the downside when you see headlines like "Bloodbath on Wall Street." That's what entices people.
Well, and I think if you read the article, it makes a pretty rational case for why this could happen, right? I mean,
why?
The two biggest market sell-offs in history, 2000 and 2008, according to this article, came when the Fed started cutting rates. I think was after 2008. But
the Fed hasn't cut rates.
No, not as I've seen yet. No.
Yeah.
But the idea here is that this appears to be very rational. Market valuations are sky high. That's another reason to
But markets go up and down. They do. They fluctuate. We've seen them come down, like in 22.
Yep.
We've seen them come down. But an astronomical decline like that has to be spurred by some astronomically important, unknowable event. See, there's the part. It's an unknowable event.
And how much is the newsletter to subscribe?
Oh, gosh, I didn't even look.
I'd just be curious to know because, I mean, this is another thing that people have a tendency to overlook is what is the motivation of Mr. Wolfenbarger? Well, to get you to pay attention to buy his newsletter. At the end of the day, right? Because the more subscribers he has, the more he's going to make, the better off he's going to be.
I got to tell you, newsletters are very profitable. I used to do one.
Right.
Holy mackerel, are they profitable? I'm
Don McDonald's BullandBearProfit.com.
And the funny thing about mine is I didn't promise anybody anything.
Oh, that's too bad because everybody wants to know what the future is going to look like. Too hard to find.
Do they make it difficult to find out what it costs? You just keep talking because I got to keep looking.
So, but back to his prediction, his less than generous look at what the future could look like, because every day people will ask us, and by the way, I got a great answer from one of our advisors, Taylor Drake, this week. Asked him about this, and he said, I tell people I just have no idea where the market is, how to respond to that, because I don't do that. That's not the work that I do. The work that I do is about you, the planning for you. Nobody knows about the market today, tomorrow, into the future. So the answer should be complete indifference, if you will, which I thought was a good response. He just tells them you're paying attention to completely the wrong thing if you're kind of looking at markets and trying to figure out what could happen. But in the article, he points to...
I found it. It's $179 a year.
$179. Yeah, he also points to unemployment ticking higher, which we have not as yet seen. I mean, there's a lot of things in here that if this happens, here's what the market's going to do. And nobody knows that either. There isn't X plus Y equals Z. Absolutely not. So that I hated. I hate this stuff in general because I think what it does is helps people make bad decisions, right? Helps you decide to get out of the market.
It actually stimulates your emotions and makes you start to question your past decisions. I mean, the market went down in 2008 like 50%, so maybe he's right. Maybe I should be out and wait until it goes back up. See, the problem is, let's assume for a second that he's right.
Yeah, I was just going to get to this. Yes.
Let's say he's right. And the market does plunge 60% later this year. Now, I'm not saying that he's right. This is a big, gigantic hypothetical that I don't buy for a second, but I'm just play along. Let's say it goes down. Oh no, let me do this one better. Let's say between now and the end of the year, the market drops 55%. Okay. Now,
you're scaring me.
Let's say it. Did you get out today based on Wolfenbarger? Well, let's say you're one of the three, a burger. Well, I don't know why I keep because I'm hungry. I want a burger.
Bring the burgers on.
There are a handful of people who are actually going to get out based on that recommendation. Few people. So now you got out and it dropped 55%. Now he said 60. So what do? Do you wait for 60?
This is the point, right? You got to know when to sell and when to buy. Yeah, people always forget there's another part of the equation, right?
In 2008, we saw the market over a half a year plunge precipitously.
Yeah, day after day.
Until early in 2009. But in the late winter of 2009, we started seeing a day where it went up and then it went down a little less than it went up. And then it went up and then it went down a little less than it went up. And then it went up and then it went down a lot. And then it went up and then it went down a little. And no one at the time, because we were talking about this on the radio, no one at the time was screaming, "Get back in! This is it! It's going back up!"
No one was telling you that it's time to buy stocks.
No, this is a dead cat bounce.
Yep,
I remember those exact words: dead cat bounce.
You're not supposed to say that. It's mean to the cats. So what? Here's a couple other things to think about.
Only those that have lived a full 9 lives can be a part of a dead cat bounce.
So you have to know, not only he can tell you to sell now, but you got to know when to buy. Number 2, and this is a fact I think gets overlooked generally when people think about stocks and stock markets. We mention it because it doesn't make us promoters of stocks. It's simply the fact. The fact is, in the past, markets, both in terms of months and years, are up about 75% of the time. So you're making a bet really about how things have looked for the long haul. And I'll say this again, and I'm really hoping Mr. Wolfenbarger would be more of a sheep in wolf's clothing. But if he was, here's what he'd tell you. Fear and greed will eat you alive, but having a plan, the right asset allocation, and sticking to it puts you in a far better place than chasing all this stuff around, which really, at the end of the day, can make your life miserable.
Yeah. And that's letting the emotions control your financial decisions make you a very unhappy investor. And a very confused investor. And the funny thing is that we have data, lots and lots of data, from all kinds of people, Fama and French and S&P, Standard & Poor's and Morningstar and many other academics around the world. We have data that shows that you, as an individual investor left to your own devices, on average, dramatically underperform just not trying to beat the market, just owning the market. You're a terrible, terrible stock picker and market timer because your emotions are a horrible way to make decisions.
And even people that make better decisions about the type of investments to use, index funds, they've had underperformance as well because, again, they get taken in by people not unlike Mr. Wolfenbarger, who says, here's what you got to do and here's what you got to do now. I think that's spot on, Don. So let's see if we can jump on a couple of questions. This comes from Essex Junction, Vermont. I don't know. And this is from Michael. I've never been up in that part of Vermont before.
I don't know where that is in Vermont. I've been to Vermont.
You're not going to take the silver bullet that far north, I don't think.
No, we are not. We're going north to Pennsylvania and then making a hard left turn.
Okay. So you're not going to HQ anymore because for a while you were thinking you would.
Not going to HQ.
They're going to be sad.
There's not enough time.
Okay.
There's not with our big to do in Madison.
All right. I was hoping you were going to offload the contents of in the parking lot there. Anyway, Michael writes, "Hi, Don and Tom. Love your podcast. Recent retiree from a large company and have a moderate risk tolerance. I've kept the lion's share of my retirement investments in my 401k with Fidelity, sitting around a 50-50 balance." I'm assuming that's between stocks and bonds. Yeah. Mm-hmm. Don't see the need to draw down until RMD age. Here's the question. I have 14% in a long-term corporate bond fund, expense ratio 0.12. My cost basis is quite a bit higher than my balance. I'm wondering if I should hold it, hoping it will recover, or cut my losses and transfer to another bond fund.
I hate long-term bond funds.
Me too.
I hate long-term bond funds because long-term bond funds, while they give you, or have in the past, not today, but have in the past given you a slightly higher rate of interest, they have such a high degree of volatility because of their interest rate sensitivity. See, when rates go up, the value of a bond fund go way down, but the longer the maturities, the farther down they go. The drops are more precipitous. And if you look at long-term charts and the history of longer-term bonds, they start to show a volatility propensity that's a lot closer to stocks than I'm comfortable with, because we believe bonds exist in a portfolio to dampen the crazy bouncing around that stocks do.
Well, and you don't have to go too far back. 2022 long-term bonds really got beat up, 20+% decline. Short and intermediate term, not nearly as bad. So yeah, keep your quality high and your maturities
low.
Intermediate. Yeah, I mean, I wouldn't get longer than 8 or 9 years.
Oh, and, even then, I would. If I was getting into a fund, I would want. Yeah, you can have some 8 or 9s in the fund, but I don't want a duration any longer than 5 years or so on the overall portfolio.
Tom from Urbana, Iowa writes us, "Hey guys, big fan of the show. Listen every day on my way from home and work. On my way home from work.
From work.
Okay.
Yeah.
Sorry, God.
I knew what you meant to say.
I know, but I'm trying. I'll be starting a new job next month. I hope the drive's just as good for our sake, and have a 457 account through the Iowa Retirement Investors Club, RIC. The 4 options are Corebridge, Empower, Horace Mann, and Voya. They receive a C grade on the 403bwise.org. 403bwise.org is where they look at these 403b plans. You can go there and look yourself. Each plan has Fidelity or Vanguard low-cost index funds, but wondering how to tell if there's any gimmicks or additional fees associated with these providers.
Oh, thank goodness. So
you can still get low-cost funds.
There are no gimmicks. There are no gimmicks. It's just that here's what happens with these. They used to be, 457s and 403bs particularly, used to be almost all insurance company investments. Lately, the trustees of these plans have realized their fiduciary responsibility to the plan.
They've probably gotten sued.
Requires something a little less expensive. So they have made the effort. You see, Vanguard will not call a 403b or a 457 and make a sales pitch, nor will Fidelity likely. Well, Horace Mann and Voya certainly will, because they make big commissions. So they have to be brought in independently for the good of the employees. So no, if you've got Vanguard available to you or Fidelity's index products, please use those. Do not use any, I can't say it enough, of those other plans.
Well, and I might use, no. I think what he's saying is those funds are available in each one of those various providers, Empower, Voya, et cetera. Yeah,
I don't think Voya makes Vanguard available, do they?
I don't know, but I think that's what he's saying here. So,
well, then we need to look at what each one charges. But
I was going to take a look at that, because I think in a general sense, I wouldn't want to be at Horace Mann, and I know I wouldn't want to be at Voya, but Empower, I think, can have some reasonable
Empower
costs.
Can have some. You just have to be very careful what you get through Empower.
Corebridge, I do not know, but so I would eliminate Mann and Voya right off the top of my head, and consider Empower or Corebridge. But Don's right. Look at the
I'm not
costs.
Finding, but they could be in there. They might be in there. I don't know. I'm trying to look. Oh, here we go. It
says each plan has Fidelity or Vanguard low-cost index funds.
Yes, okay, they do. Yeah, because I'm looking at LA Unified, and they have a Voya account.
Yep.
And they do have Vanguard in it, but I'm not sure if it's through Voya or if it's separate. I guess it is through Voya. Okay, great. If you can get Vanguard, then the real key is to find out what their administrative costs are, and those are generally small.
Should be. I mean, you shouldn't be paying more than 0.25, 0.3.
The only problem, the only thing I worry about, and this might be worthy of a meeting with whomever manages that at Voya or any of these, I would probably lean toward Empower, because Empower does more of this, but any of them, talk to them and ask them, what products do you suggest?
No, that could be painful answer.
I know. Well, it'll tell you a lot about the honesty of the person with whom you're working. And I think that's also a big factor. You need to know that you're working with someone who really does care about what's best for you, not them.
Boy, wouldn't that be nice? What a world you're thinking about there. I love that. Yeah.
I'm a crazy person.
That's optimism of a high level, my friend. So, okay. We'll hope that works out. So thank you for your question. Thank you for listening. Want to mention a couple of things. You want to see Don along the way on the road here coming up fast. Go to talkingrealmoney.com.
We're going to be driving slowly, though. Coming up
like
fast, but driving slowly.
You're not passing anybody. You can learn more at talkingrealmoney.com. It's right on the homepage. It tells you where he's going to be. Mm-hmm. We are going to be, I know, in Madison, Wisconsin on July 20th for a little Talking Real Money cookout. So if you're in the upper Midwest somewhere, come out and join us. You do need to tell us in advance because Don's only chugging along with a certain number of hamburgers in the back of the Silver Bullet. So join us there. We're also going to be back in beautiful Hartford, Connecticut on October 19th for Retire Meet East. Limited tickets. So get those now. I know it's a long way off, but take advantage of that.
Yep.
Great speakers, and that'll be a fun day too. So take advantage of all the free stuff. We don't have a lot of availability. No, and it's not free, by the way. It's free for the cookout, not free for retirement. It's a very small cost. So
free food, but not free education?
Doesn't make any sense, but we're not in charge, as you know. So
yeah, we are definitely not in charge.
You knew that one coming. Yeah.
All right, everybody. Thank you so much for being a part of our podcast. We really, truly appreciate you. And
wait, did I hear you're replacing me when I'm gone or something too?
I'm working on it. I'm auditioning replacement hosts.
That's what price you pay.
In the interim, it's a coup d'etat.
Only interim. So I get my job back when I return.
Not necessarily.
Oh, okay.
So a coup can mean that you never get your job back and you'll be exiled.
If they're good, if they're decent, if they can read, if they can pay attention, then I guess that's it. All right.
You'll be exiled to Kenya.
Yeah, I guess there's worse things that could happen. So sure.
All right. Are you done now?
That's it.
Okay, we're out of here. Thanks so much for being with us as we sit around in our respective studios doing this thing, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.